Hello and welcome to the March 20th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver Kennedy, and I thank you so much for joining me today. Before we get into the questions that have been submitted by our community, I just want to share with you a bit about the center, its vision, and then issue a quick disclaimer along with some updates, and then we'll go straight to the questions that have come to us about navigating student loan repayment. So, the Maryland Center for Collegiate Financial Wellness was founded in 2021 with a vision for all of Maryland's college and career school students, and that was that they be able to achieve these 6 pillars of collegiate financial wellness. Those are being creditworthy, ready, resilient, empowered, successful, and thriving. We have several programs and initiatives that are working to achieve this vision, and if you're interested in learning more about those programs and our activities, please do visit us online at mccfw.org, and we are also on socials at the MCCFW. And a quick disclaimer before we get into the questions that have been submitted from our community. Office Hours is presented for informational purposes only. The information presented here does not constitute personal, legal, or financial advice. We try to give you the best, most up-to-date information as possible, but there are a lot of changes going on, and even outside of those changes, everyone's personal circumstance is different. Your loans, your household characteristics such as income and family size. There are lots of things that have to be considered before you make decisions about student loans. So we are glad that you've tuned in and hope you consider us to be a reliable source to help you as you consider your options and make decisions about navigating student loan repayment. Very quickly, before we get into the questions, I just wanted to share a few updates. Of course, number one is that we've had more victories brought to former borrowers by way of the Public Service Loan Forgiveness Program. Some of those victories have come from my high school, Eleanor Roosevelt High School in Greenbelt, Maryland. I've been there a couple of times in the past week, and on each visit, I've been able to celebrate with someone who's had their loans forgiven. So congratulations to all of the PSLF victors out there. We're rooting for you, and we thank you so much for your public service. On the policy front, at the state level here in Maryland, House Bill 811 has been approved unanimously or voted unanimously, approved by the House of Delegates. And actually, there is a hearing today in a Senate committee to learn more about this bill that would establish a pilot program that would place 2 financial well-being coaches at campuses in the state, at University of Maryland College Park and Morgan State University. So we are thankful to Delegate Sarah Wolek for proposing that legislation, and we are looking forward to hearing more about the progress of the bill now that it has landed in the hands of the Senate. On a federal note, the income-driven repayment adjustment that we've been talking about since 2022, the period to benefit most greatly from that adjustment is going to end on April 30th of this year. So we'll talk about some actions that borrowers need to take by that time in order to reap the greatest benefit. But the deadline is coming. That's a little bit more than a month away. That's April 30th of 2024. So we're pushing forward with lots of programs and continuing to spread awareness. And speaking of spreading awareness, we have another opportunity to do that, this time in Baltimore City on this Saturday at Money Power Day, the state's largest financial fitness fair, which is presented by the Cash Campaign of Maryland, our longtime partner. And that will be at Poly Western High School in Baltimore, Maryland, this Saturday, March the 23rd. All right, let's get into our questions. The first question is, about 500 people that were forgiven for public service loan forgiveness will or have already had that forgiveness reversed due to an error in incorrect payment count. Am I in danger of having my forgiveness reversed? This is a question that we've heard from several borrowers, but fortunately, none of the borrowers that we've worked with have received anything about their forgiveness being revoked. So a little bit more background on the person that this question came from. This is actually a retiree who was a full-time public servant from 1992 to 2019. They entered repayment prior to when public service loan forgiveness was enacted on October 1st of 2007, and they remained in repayment throughout their employment and even after retiring. They consolidated their loans in October of 2022 so that they could take advantage of the limited PSLF waiver before it expired. And they uploaded their PSLF application directly to MOHELA.com during that limited waiver period. They reported that their payment tracker never updated after October of 2022 when they consolidated, but they did receive loan forgiveness. So since this question, it has a lot to do with the tracking of payments and whether accounts are correct or whether you should be concerned about your forgiveness being revoked because the account was incorrect. I just want for everyone to get more familiar with what the payment tracker looks like and where you can find it. So if you log into MOHELA.com, you'll see that navy blue navigation bar, horizontal navigation bar. PSLF is an item there. You want to click on PSLF and then a drop-down menu will appear and you should see the payment tracker toward the bottom of that drop-down list. Once you get to the payment tracker, you're probably going to see 3 or 4 text boxes, and after you scroll past all of that text, you'll get to these 4 boxes. 3 of them are blue right now. The first one is white because that's the tab that we're currently on, payment counts. Payment counts is where you can actually see the number for each of your loans. And for public service loan forgiveness approval, we're looking for the number of 120. So let's take a look at a payment count. This is a sample payment count. This person has 2 loans, and you'll see that in the middle, there's kind of like a goalpost of forgiveness. And to get to that goalpost, you have to have 120 qualifying payments. And if you look at this count, this borrower has 3 payments out of the 120 that are needed to get approved for PSLF. But the payment tracker only shows you qualifying payments. The count begins with your eligible payments, and out of the eligible payments convert once the employment has been confirmed for that eligible period. So it's good to dig deeper and click on that blue link that says show payment summary, and you can see that blue link for every loan that you have. So here's what happens when you click on the show payment summary. This shows you one loan where you can tell the borrower has 3 qualifying payments, but if you look at the eligible payments, you'll see that the number is much larger. That sits at 69. This means that the borrower has a possible 69 months that could qualify toward public service loan forgiveness. But in order for all 69 months to count, employment has to be certified. The qualifying payments tell us that this borrower only has 3 months for which the employment has been certified. And if they're able to certify the remaining 66 months, then they will have a total of 69 qualifying payments. So if you're able to still look at that payment tracker, go in, look at the payment summary, see how many eligible payments are there and see how many qualifying payments are there to determine if that count has been updated. I'm not sure that if you receive forgiveness that you would even be able to see the payment tracker anymore. I don't know how that's working out for people who have had the forgiveness reversed. I would imagine that their payment tracker should be restored so that they can see their records and they'll know the scope of the counting error. So if someone had previously been approved for 120 qualifying payments, and now that it's been revoked, let's say they're at 108, that means that they have 12 months left where they would need to be in repayment and also have that qualifying employment. So I hope that this is straightened out soon. Unfortunately, we haven't heard, or at least I haven't heard an official explanation for the errors. I haven't heard directly from a borrower who's been affected by it. So I'm sorry, I cannot fully explain what you would see inside of MOHELA if you log in. But my recommendation would be to just wait for more information. If you have not heard about that forgiveness being revoked, then, don't bring that energy upon yourself. Just wait for more information. You can log on to MOHELA.com and see if anything has been changed or updated. But if you have not received an official notice that your forgiveness has been reversed, then, just await more information. And I hope that, the accounting was correct for you and that it will not be reversed. I also just wanted to point out that since this person is a retiree, this could put them in a strange situation because the limited waiver allowed for retirees to gain approval for PSLF even though they weren't still working. But now that the waiver has expired, that door for retirees has closed. So if someone had been approved and then they see that their new updated count is less than 120 months, they would need to get more employment while in repayment so that they could make it to 120. So for retirees, this is a particularly, alarming situation. We will continue to hear from borrowers and see if there's anyone who will, let us go into MOHELA.com and see what they're seeing if they're in this situation. But if it hasn't hit you yet, I hope that it will not. I want you to also keep in mind that after public service loan forgiveness has been approved, usually your account history is wiped out from the online portal. And when you log into MOHELA.com on the homepage, you'll see an account alert that says, your debt has been discharged by way of the public service loan forgiveness program, along with the effective date. So you would not be able to see the loans there if they have been forgiven. Also, the PSLF payment tracker is no longer available. From the recent victories that we've seen, once a person sees that account alert that the discharge is taking place, the rest of the records are no longer there for them to see. So keep your paperwork if possible, document things. And if this happens to you with the reversal, please do reach out. We would like to learn more about your experience, and perhaps, we can help with reconsideration or making sure that you get on track to get to 120 as soon as possible. All right. So our next question is, I had 4 months of employment at a 501c3 nonprofit organization that was previously greenlit, by MOHELA and federal student aid. Now it doesn't count. Can I get those 4 months back? So another question about public service loan forgiveness and qualifying employment. So the question mentioned that the person was employed at a 501c3 nonprofit organization. However, there's a bit more detail here. The organization closed in early 2014, and the person is employed at another nonprofit organization currently. But with those 4 months at the nonprofit that's now closed, they would have reached 120 qualifying payments. So remember, PSLF has to do with the type of organization you work for. And 501c3 tax-exempt organizations are considered qualifying employers for the purposes of PSLF. But sometimes these organizations shut down. And if they've shut down, you can't go back and get someone who represents the organization to verify your employment. There is a self-certification option, though. You might not have, you might have documentation of your employment for the organization, but you might not have documentation of the fact that the organization was indeed a 501c3 tax-exempt organization at some point. So what I would recommend is going to the IRS's website, irs.gov. IRS has a tool that's called Select Check, where you can look up the status of tax-exempt organizations, and you can also find documentation around formally tax-exempt organizations. If you have the organization's employer ID number or their name and location, you can search the Select Check database. And from my experience, I've been able to find organizations, and there's a list of sometimes they're 990s, which are annual filings, but also sometimes the determination letter is there that shows when they were granted the 501c3 tax-exempt status. And sometimes there's also a revocation letter there that provides the date that the 501c3 tax-exempt status was revoked. So if you go to Select Check and you're able to find those letters, then I would use those letters as supporting documentation to prove that the organization was a qualifying employer at the time that you worked there. I would also recommend that this borrower continues to submit PSLF applications for their current employer so that they can document that they've reached 120 as soon as possible. And if those 4 months are reinstated, perhaps they can receive a refund for overpaying by at least another 4 months, because the loans have to be direct already. And if you make payments on a direct loan over 120 qualifying payments, then you should be refunded for those extra payments. All right, let's move on to our next question. That is, I was approved for the SAVE plan and my repayment starts next month. My monthly payment is going to be $5. If I go in and pay $50, would that pay down my loan or would it all go to interest? This is an interesting question because the SAVE plan is still very new. SAVE just launched last summer, and a large part of SAVE is the fact that it includes an interest subsidy. This interest subsidy is there to prevent your loan balance from increasing as you continue to make your monthly payments on time through the SAVE program. So this person is asking, well, if I pay $5, I know that, that's the minimum payment, but if I want to pay more, what effect is that going to have on my loan balance? So here's an example. The interest that's accruing is $50 per month. This person, if they just send in a payment of $5, the government subsidy will cover the remaining $45 worth of interest. And this is what would prevent their balance from growing going forward. Now, an extra payment should be applied to principal. I say should be applied to principal because when you pay extra on a federal student loan, they take care of interest, penalties, and fees first, and then principal. If this loan is current and a person chooses to pay extra, my mind says that the extra amount should be applied toward the principal, but I don't know how this works practically because some people who are enrolled in SAVE have reported that they're still seeing the interest accrue. And if that's the case and you send in an extra $45, I would think that that would go towards the outstanding interest. Other people are seeing that the interest is covered. So perhaps for them, if they sent in an extra $45, that would make it to the principal. The bottom line here is that we need to see more, or I should say, we at the center need to see more of how SAVE is playing out in real life, because in theory, you just have to make the minimum payment and any excess interest will be covered by the government. But if you send something extra in, then it would go toward whatever's outstanding. And if that interest is still outstanding there before the subsidy kicks in, I would think that the interest would be paid first because that's the order that payments get applied to: interest, penalties, fees, then principal. So I would contact your servicer to ask about paying extra. Perhaps you need to submit it as two separate payments. I know with servicers, you can go in and you can target specific loans for your extra payments. And I really want to hear more from borrowers about this. And I will actually reach out to some that I know who are enrolled in SAVE to see what happens if they try to make an extra payment and how that is applied. So more to come on this question as we see how SAVE works in real life. All right, let's move on to our next question. That is, MOHELA is stating that my husband made 173 payments. Will he actually get a check for the extra payments he made? And any idea how long this takes? All right, so about this question, this is for public service loan forgiveness. I have a quick clarifying point that I would need to get from the borrower, which is what kind of payments are we talking about? Are we talking about 173 eligible payments or 173 qualifying payments? If it's 173 eligible payments, we would need to know how many of them are qualifying. And then based on the qualifying payment number, we'd be able to determine if a refund is in order. So I'm going to assume that these are qualifying payments. And with the refund question, it depends on loan types. If the loans were direct, then refunds should be issued for payments that were made after the 120th qualifying payment. So if your loans were direct all along and you have 173 qualifying payments, then you should get a refund for the payments that you made over the 120th qualifying payment. Keep in mind, though, that we did have the CARES Act forbearance that was for more than 3.5 years. And if no payments were made, you would not get a refund for those months. But the additional months of payments would be refunded. And I can tell you that that is real. I know many borrowers who have received refunds. Some have received them by direct deposit. Others have received them by paper check. But the refund possibility is very real. The other situation is if the borrower had non-direct loans that were recently consolidated into the direct loan program. The status of a refund would depend on the date that the loans became direct. So if your husband just consolidated the loans and received a payment count of 173, the only time that he might be entitled to a refund is if he made a payment after the direct consolidation loan had been dispersed. So non-direct loans, refunds are not issued, but those loans have to be consolidated into the direct loan program for you to be eligible, for them to become eligible for PSLF. But the only thing that could possibly be refunded was payments made on a direct loan after the loan reached its 120th qualifying payment. As for the timing of the refunds, from what we've heard, the timing varies. Some people are seeing the credit amount in their actual forgiveness letter. When they get the congratulations, you've been approved letter, it usually has a table that lists all of the loans. And for some people, they're seeing a credit balance for each loan. And from what we've seen, that credit balance represents the amount of the refund that you would receive. As for the timing of refunds, like I said, it varies, but the prospect of the refund is very real, especially if your loans were direct all along. All right, let's move on to our next question. It is it okay to file jointly after final certification, which includes IRS consent? So this question has to do with income-driven repayment and the recertification of income to stay on an income-driven repayment plan. So I needed some more background to be able to give a full answer to this question. So for this borrower, August of 2024 will mark their 120th qualifying payment. So congratulations in advance and thank you for your public service. This borrower has been filing as married but separately, but for the 2023 tax year, they're going to shift to married filing jointly. According to their servicer, which is MOHELA, their income-driven repayment renewal date is March of 2025. They gave their consent for the Department of Education to transfer their income information for recertification. So that transfer would take place automatically. At the heart of their question is, will the Department of Education or MOHELA increase their monthly payment for the next few months because they are now filing jointly for the very first time? So when you are married filing jointly and your spouse has income, that means that your adjusted gross income is probably going to rise. And if your adjusted gross income rises and everything else is held constant, your payment under an income-driven repayment plan will rise. So that's what this person is wondering. If I change to married filing jointly, is my payment going to rise? Now, the payment would rise the next time your income is certified, but the payment would not rise immediately after you file your taxes. In this case, the next renewal date for IDR isn't until March of 2025. So if you file your 2023 taxes now, that information is not going to be transferred over to the Department of Education and used to determine your payment. So just keep in mind that the recertification process for income-driven repayment is something that typically happens once per year, and your anniversary date is set for 2025. So it's not going to happen anytime soon. And since this borrower's public service loan forgiveness approval date that we're hoping for is August of 2024, that would be before they're required to recertify for income-driven repayment. So in this situation, their current monthly payment would not be affected by the 2023 tax return or their filing status because their anniversary date for recertification of income is not until 2025. So for this borrower, please don't worry. You've got a few months left as long as you maintain that employment and continue to make your payments on the income-driven repayment plan. You want to make sure that after you make that 120th payment in August, you submit your final PSLF application so that your employment can be verified through August. And then after processing, the debt should be discharged. Your 2023 tax return is a completely separate financial matter that will not affect public service loan forgiveness or your payments for the next few months. All right, next question. Should I be concerned about my remaining 3 loans that have yet to be forgiven, although they have a count of 121, considering there's time until April for them to be forgiven as well? So this is a relatively new phenomenon that we've observed starting with maybe like a month ago. We're seeing borrowers who are experiencing partial forgiveness through public service loan forgiveness. A bit of background about this borrower: they had 6 loans forgiven with 3 loans left, and all loans have 121 qualifying payments. Now, for PSLF approval, you just have to get to 120. So if all of the loans have 121 qualifying payments, then all of the loans should be approved for public service loan forgiveness. And we would think that that approval would happen for all loans at the same time. And up until recently, that's what we've seen. When all the loans have the same amount of qualifying payments and that number is 120 or higher, then the loans are usually discharged at the same time. But what we've been seeing as of late is some loans are approved and included in that congratulations letter, and some loans are left behind, even though they have a qualifying payment count of higher than 120. Officially, we have not seen any explanation yet for partial forgiveness. Just keep in mind, PSLF requires 120 qualifying payments, and we know that that requirement has not changed. Once the employment has been documented for all 120 months, the remaining balance of those loans is supposed to be forgiven. Quick note here: because this question mentioned there's time until April 30th for the loans to be forgiven, PSLF is not going away April 30th. April 30th is the deadline for the income-driven repayment adjustment, for you to get the greatest benefit from that adjustment. So certain people need to take action. People who have non-direct loans need to apply to consolidate by April 30th so that they'll be included in the IDR adjustment with the greatest amount of credit. But PSLF is not going away. So don't worry about April 30th if you already have 121 qualifying payments and you're just waiting on the discharge, kind of as a formality. You could reach out to MOHELA since your payment count has reached more than 120. What we've seen lately is that they're putting people into administrative forbearance so the payments aren't required while the discharge is processed. So hopefully you are in that place where you're not required to make any payments. And even if you were required to make payments, you should get a refund once that final discharge happens for the remaining 3 loans. So hang in there. If we hear any official explanation about partial forgiveness, we will make sure that we share that in our future content. All right, let's move on to the next question. I heard I can consolidate my loans and they would then take the highest number of payments, which is the first 2 loans that will be at 120 after the buyback, and all will be forgiven. So this question is about PSLF as well, but it's also bringing up something new, which is called the PSLF buyback. I want to tell you a bit about the buyback. Well, first, a bit more about this borrower. They have 2 loans that have qualified for the buyback. They can make a one-time payment for those 2 loans, which will bring them up to 120 qualifying payments, which means the rest of the debt will be discharged. Their remaining loans are at 95, and this reconsideration request related to the buyback does not apply to those 95 or those loans with 95. The question is, if I consolidate, will I no longer be eligible, thus losing out on 25 payments and having at least 2 of my loans forgiven? So I want to preface this by saying that the PSLF buyback is new, so we definitely need more time to observe how this buyback works in real life. But the IDR adjustment, particularly consolidation during the IDR adjustment, is something that we've had quite a bit of experience with, or at least as much as you can have since 2022. But quick note about the IDR adjustment and the rules around consolidation. This question mentioned the greatest benefit inside of the question, which was that if you consolidate by April 30th, the consolidation loan will receive at least the same amount of credit as the individual loan with the greatest amount of history. An example of that would be if you took out loans 10 years apart and you combine those loans through consolidation, the entire consolidation will be treated as if it was in repayment when those 10-year-old loans went into repayment. So everything gets sped up in terms of its progress toward the forgiveness milestone. In theory, since the income-driven repayment adjustment is still going on and that period to get the greatest benefit doesn't expire until April 30th, if you consolidate, all of the loans included in that consolidation loan would get the benefit of the history attached to the oldest loan in the portfolio. So I'm looking at the reconsideration request aside. If you consolidate during this IDR adjustment period before April 30th, then you would get that benefit of the whole loan being credited with the history of the oldest loan in the portfolio, or the loan that has the greatest amount of history. Now, the buyback interjects a totally new element into this. And I just wanted to pull some language officially from the Department of Education because this buyback is new and we don't have much experience with it yet. The buyback opportunity is only available to you if you already have 120 months of qualifying employment, and buying back months in forbearance or deferment would result in forgiveness under public service loan forgiveness or temporary expanded public service loan forgiveness. So the buyback isn't for everybody. This is for people who already have the 10 years of employment, and that buying back certain months would get them to a place where those months would reach 120 months. You'd basically be granted forgiveness. So a little bit more about the buyback and what you can and can't buy back. You can't buy back months during which your loan was in any of the following statuses: in school or in origination, in grace, in default, bankruptcy, or in total and permanent disability monitoring. So there are several limits to this buyback, but at the root of this question is, are you going to get the benefit of the IDR adjustment, which is that when you consolidate loans with differing amounts of repayment history, that consolidation loan gets at least the same amount of history as the loan in the portfolio that has the greatest amount of history. So if we push the buyback off to the side and just focus on the timing of the loans, then the IDR adjustment is still valid because we're at March 20th and that deadline doesn't come until April the 30th. So if you consolidate all the loans will be placed on a clock that gives you credit for the same amount that's attached to those more mature loans in your portfolio that you mentioned. After that consolidation loan has dispersed and your employment is reviewed again and you see that new count, then you could go back and do the reconsideration or the buyback to get to 120. So I totally understand the hesitance to mess with things. But during the IDR adjustment, in my mind, the IDR adjustment is the overarching thing that's happening right now that you want to take advantage of so that all loans can be placed onto the same repayment clock. Once the IDR adjustment piece of this maximizes benefits for you, then PSLF is a separate benefit. Then within PSLF, the buyback is a mechanism to help you benefit from your previous employment of at least 120 qualifying months already. So a layered issue. I'm hoping that we'll see how this borrower chooses to proceed so that we'll know more about how this buyback works in real life with PSLF and how that flows up into the IDR adjustment. All right, I think we're at our last question, which is, I heard about the April 30th deadline. Is that when TEPSLF is going away? Okay, so I wanted to just rewind a little bit and talk about the difference between PSLF and TEPSLF. So both of them are public service loan forgiveness, but TEPSLF stands for temporary excuse me, I got tongue tied. PSLF is public service loan forgiveness. TEPSLF is temporary expanded PSLF. So one of them, think of it as permanent, or at least as long as it's the law. That's PSLF. It was enacted in October of 2007. It has no expiration date. So PSLF is ongoing. The rules are clear. We're in an IDR adjustment, which affects it. But even after that IDR adjustment period is over, PSLF will continue because it's federal law. TEPSLF, on the other hand, is a temporary expanded version of PSLF that was meant to rectify that 98 or 99% rejection rate that PSLF had in its first 4 or 5 years. With TEPSLF, it doesn't have a deadline like the IDR adjustment or the limited waiver. We know the limited waiver expired October 31st, 2022. The IDR adjustment, that period for the greatest benefit is set to expire April 30th of 2024. With TEPSLF, there was no date assigned to it. There was a funding allocation, and the expiration date of TEPSLF is tied to when that funding runs out. So to answer the question very quickly, no, TEPSLF will not expire April 30th to my knowledge. TEPSLF is a program that's expiration date is linked to the exhaustion of the available funding. Once the funding is exhausted, then the program will end. So that's not a calendar date set for the end of that program. So PSLF is ongoing because it's federal law. TEPSLF was, added to improve outcomes for PSLF applicants. And once that funding allotment has been exhausted, TEPSLF will go away. All right, that was our last question. So I want to close out by making sure that Marylanders are aware of our state student loan ombudsman through the Department of Labor. If you're encountering any problems with your student loan servicer, you can reach out to the student loan ombudsman to assist you with issues that may include failure by the servicer to communicate with a borrower, errors in crediting principal and interest payments, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidations or modifications errors, and or inappropriate collection activities or tactics. So if you're having issues with your servicer, you want to make sure that you reach out to them to try to resolve those issues in good faith. If you find that that correspondence or that interaction isn't leading to a solution, then I would encourage you to access or reach out to Maryland Student Loan Ombudsman. If you're outside of Maryland, you can reach out to your state's ombudsperson if it has one, or you can reach out to the Consumer Financial Protection Bureau online at consumerfinance.gov to submit a complaint. You could also reach out to the Office of Federal Student Aid because they have an ombudsman as well to address specific concerns. You can go to studentaid.gov to learn more about the specific issues that FSA Student Loan Ombudsman addresses. All right. So that does it for this episode of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. We are online at mccfw.org and all over socials at the MCCFW. So I encourage you to please stay in touch. I thank you for submitting your questions. If you have a question, you can submit it at mccfw.org/contact. We will either answer you or perhaps we will use your question in a future edition of Office Hours. I'm going to check comments very quickly to see if we have any, and I don't see any at the moment. Like I said, if you have questions that come up in the future after the broadcast is over, you can reach out via social media, tag us at the MCCFW, or submit that question through the contact form, which is mccfw.org/contact. As always, I thank you so much for joining us for this edition of Office Hours. Office Hours is presented as a public service. This is something we present for free for the benefit. We're focusing on Marylanders, but we hope the information is useful for student loan borrowers wherever you happen to be. If you are a fan of Office Hours, you can subscribe to our YouTube channel. We are at the MCCFW. You could also provide financial support. We are a 501c3 tax-exempt organization, and you can make a donation online at mccfw.org/support. And again, you can reach out to us through our website, mccfw.org, and submit a question through the contact form. I do want to just mention an event that we have coming up. It's not for another 4 months, but it's our annual virtual symposium, Advancing Collegiate Financial Wellness as an Essential Ingredient for Student Success. We are hosting the symposium this year on Tuesday, July 23rd from 9 a.m. to noon. It's a completely virtual event. So if you are interested, please do visit the website. There's a symposium page there where you can view the footage from 21, 22, and 23, because this will be our 4th year hosting the symposium. We keep it virtual because even though our focus is on Maryland, we have people that are tuning in from across the country, a few in Canada, and a few from as far as Asia. And we want to keep it virtual so that it's accessible to all who are interested in advancing collegiate financial wellness. So please save the date, July 23rd of 2024. We'll be online from 9 to noon. I'm going to check just one more time to see if we have any comments that have come in. None. I don't see any. So we will be back a bit quicker this time around, because today's edition of Office Hours was actually had been postponed last week. I had some work done nearby. It was really loud and didn't want that to interrupt the broadcast. So today's episode on March the 20th, we have another one scheduled for March 27th. So we'll be back next week answering your questions and helping to prepare Marylanders for financial success beyond student loan repayment. Thank you again so much for your time, for your attention, for your engagement. We'll get this episode annotated and uploaded to YouTube very shortly. And again, we appreciate your questions, your support. And until next week's edition on March the 27th, take care and be well.